Hello and welcome. Thanks for joining us. Today's discussion has been arranged by the experts at ProTax Accountant, a really well-respected firm here in the UK.
Glad to be here.
We're tackling a question that honestly comes up a lot. How on earth does HMRC actually know about cash gifts you might have given?
Yeah, it's a common one. And, it's true. HMRC isn't tracking every tenner you give your niece for her birthday.
Right, okay.
But for larger gifts, especially thinking about inheritance tax, they definitely have systems and, well, methods in place.
Okay, so not the small stuff. We're talking more significant amounts.
Yeah.
So how do they find out? It's not like they have a, direct line into everyone's current account, right?
Not quite like that, no. One of the main ways is actually through self-reporting.
Self-reporting, how does that work?
Well, when someone passes away, the executors, the people sorting out the estate, they have to fill in an inheritance tax form, the IHT 400. And on that form, they're legally required to declare any gifts the person made in the 7 years before they died if those gifts went over the annual allowance.
Which is, what, £3,000?
£3,000 currently, yeah.
Yeah.
Though it can be £6,000 if you didn't use the previous year's allowance, so executors have to list those out.
Okay, so the onus is on the executors. But, what if they don't know about a gift? Or, let's be honest, what if they maybe choose not to declare it?
That's a valid point. And that's where HMRC's own systems kick in. They have this pretty powerful computer system called Connect.
Connect sounds encompassing.
It is. Think of it like a huge data hub. It pulls information from all sorts of places. Banks, the land registry for property stuff, even sometimes public records or social media, believe it or not.
Really?
Yeah, it crunches all that data looking for discrepancies. Like if someone suddenly buys a big asset, but there's no record of them earning enough or taking out a loan, that could flag up a potential undeclared gift.
Wow. Okay. That's quite sophisticated. Are there other triggers, things that might make HMRC look closer?
Definitely. Anti-money laundering rules, for one.
Oh, of course.
Banks have to report suspicious or just very large transactions. Say someone transfers £50,000 for a house deposit. If that person then sadly passes away within 7 years, HMRC might spot that large outflow during the estate review and ask questions.
Right, linking it back. And what about money going overseas or coming in?
Good question. There's something called the Common Reporting Standard, CRS. Basically, banks in participating countries automatically share information about accounts held by residents of other countries. So a large international gift. HMRC could well get notified through that channel.
It feels like the net is quite wide then.
It is, yeah. They also sometimes get, tip-offs from people. It happens. And increasingly, they're using AI, artificial intelligence, to analyze financial patterns, looking for things that look unusual, things that might indicate gifts that haven't been declared.
Okay, so multiple angles. Connect system, bank reports, international agreements, AI. It all seems to circle back to why this matters so much, which is inheritance tax, right?
Yeah.
7-year rule.
Exactly. That's the absolute core of it. If you give a cash gift, unless it falls under an exemption and you pass away within 7 years, the value of that gift can be pulled back into your estate for IHT calculation purposes.
And the threshold for IHT, the nil rate band, is currently £325,000.
That's right, for 2025-26. Anything above that in the estate's value, including those taxable gifts made within 7 years, is potentially taxed at 40%. It's a significant rate.
40% is steep. You mentioned gifts becoming exempt after 7 years, though.
Yes, those are called potentially exempt transfers, or PETs. If you make a gift directly to another individual, it's a PT, survive for 7 years after making it, and poof, it's completely out of the IHT picture, doesn't matter how big it was.
So outlive the gift by 7 years, and you're clear.
Basically, yes.
But what if someone dies, say, 5 years after making a large gift? Not quite 7 years.
Okay, that's where taper relief comes in. It doesn't wipe out the tax completely, but it reduces it. If you die between 3 and 7 years after making the gift, the 40% IHT rate on that specific gift gets reduced.
On a sliding scale.
Exactly. Die between 3 and 4 years, the rate on the gift is 32%. Between 4 and 5 years, it's 24%, then 16%, then 8% if you die between 6 and 7 years after the gift. After 7 years, it's 0.
That's helpful, a bit of relief there. Now, are there gifts that are just exempt straight off the bat, regardless of the 7 years?
Yes, absolutely. And using these is key for planning. The main one is the annual exemption. Everyone can give away £3,000 total each tax year, completely IHT free.
Okay.
And importantly, if you don't use all your £3,000 in 1 year, you can carry the unused bit forward for 1 tax year. So you could potentially give £6,000 tax-free in one go if you hadn't used the previous year's allowance.
Right. Useful to know. Any others?
There's a small gifts exemption. You can give up to £250 per person per tax year to as many different people as you like. The catch is you can't give someone £250 and use your £3,000 annual exemption on the same person in the same year.
Okay, 250 to lots of people is fine.
Right.
What about weddings?
Yes. Special allowances there. Parents can give up to £5,000 each to a child for their wedding or civil partnership. Grandparents, £2,500. Anyone else, £1,000. Generally, these need to be made just before the big day.
Good specific ones. And, what if someone helps out family regularly, like paying for school fees or just topping up their income?
Ah, yes, the normal expenditure out of income exemption. This one's potentially very valuable, but also quite specific.
That's so?
The gifts must be regular, made out of your surplus income, so after all your normal living costs are covered. And crucially, making these gifts can't affect your own standard of living. If you meet all those conditions, these gifts are completely IHT exempt, and there's no upper limit.
Wow. Okay. But you need proof, presumably, like bank statements showing the regular payments and that you had enough income left over.
Absolutely. Documentation is vital for that one. Which brings us to a general point.
Record keeping.
Yes. For any significant gift, keep records. Date, amount, who got it, maybe why you gave it. Bank statements, a simple letter confirming the gift, it all helps your executors later on if HMRC asks questions.
Makes sense. Because the consequences of not declaring when you should, they can be pretty harsh.
Very much so. There was a case, Clayton Hutchings in 2023, it got some press. Failure to declare a large gift, around £440,000, I think, led to a penalty of about £87,000. HMRC can charge penalties up to 100% of the tax owed, plus interest. It's not worth the risk.
Definitely not. We focused on cash, but gifting property, that's a whole different ballgame, right? Tax-wise?
Oh, yes, completely. Gifting property brings in potential capital gains tax for the giver, maybe stamp duty land tax for the receiver. It's much more complex than just cash.
Okay, something to bear in mind. And what about business owners? Does HMRC look closely if money comes out of a business as a gift?
They certainly can, yes. HMRC is wary of funds being taken from a company, perhaps labeled as a gift to a family member, when really it might be more like undeclared dividends or salary.
Ah, trying to avoid income tax or corporation tax.
Potentially. There was a case involving a Birmingham business owner in 2024 where this was scrutinized. If HMRC reclassifies it, it can trigger unexpected tax bills. So business owners need to be extra careful about how they extract funds.
Right. One last quick thing from the recipient side. If someone receives a cash gift, do they generally need to worry about tax? I saw something on the gov.uk forums about this.
Generally, no. HMRC confirmed this on their own forum. Receiving a pure cash gift usually has no income tax implications for the recipient. The main tax focus is inheritance tax on the giver's side. Of course, if the recipient then invests that cash and earns interest or dividends,
Then that income is taxable as normal.
exactly. But the gift itself usually tax-free for the receiver.
Okay, that's clear.
Right.
So wrapping this up, it sounds like small everyday gifts are fine, unlikely to attract HMRC's attention.
Correct.
But larger cash gifts, especially those relevant to inheritance tax planning, are definitely on HMRC's radar. They have their methods, self-reporting, data analysis via Connect, bank info, international sharing.
That's the picture, yes. It underlines the need to understand the rules, use the exemptions like the annual one or normal expenditure where they apply, and crucially, keep good records.
Keep those records. And if this has raised questions for anyone listening, if they're thinking about making significant gifts or perhaps dealing with an estate, professional advice seems pretty essential.
Absolutely. Given the complexities and the potential tax implications, getting tailored advice is highly recommended. And for that, contacting a firm like ProTax Accountant would be a very sensible step. They deal with this day in, day out.
Great advice. So if you do have more questions or need that specific guidance on cash gifts, IHT, and making sure everything is handled correctly with HMRC, do reach out to ProTax Accountant.
They'll be able to help.